I'm Erin Hines with Elliott Wave TV. Today I'm talking with Wayne Gorman, head of EWI's Educational Resources. Wayne, you're often asked, what did I do wrong, by investors and traders. Can you share a common mistake that you often see investors or traders make?
Hi, Erin. Yeah, sure. What I'd like to do actually to answer that question is perform a little experiment. This is a chart of the S&P 500 stock index. It's a weekly bar chart over a certain period of time in our history. During this time, one of the biggest financial scandals in U.S. history occurred. Where do you think in the stock market this financial scandal took place?
My answer is C.
The correct answer is J. This was the Enron scandal. It broke into the news in late 2001, in the fall actually of 2001, after the S&P 500 index had already fallen 39%. Many people, when I ask this question, will pick C or G or E, because one of the biggest mistakes that people make is they think that events, as reported in the news, lead stock market trends. And this is a myth. The stock market went up after the scandal broke out. It didn't even continue to go down.
Wow, that sounds like an easy mistake that somebody could make. What else do people do wrong?
The other mistakes that people make are that they use macroeconomic indicators to forecast markets, or microeconomic data, or they think it's a function of the Federal Reserve action, or lastly, they take the easy way about investing, which I'll explain later. Yeah, this is a chart of the S&P 500 stock index along with U.S. Treasury bond yields, and you can see there's no correlation. A lot of people think falling interest rates will make the stock market rise, and rising interest rates will make the stock market fall, but it's not the case. Now, if we go to the next slide, I just want to talk about microeconomic factors. A lot of people think earnings drive stock market trends. But what you see here in this period from 1972 to 74, S&P 500 reported earnings went up dramatically, but the S&P 500 stock index fell during this time. So you can't just go by earnings or these types of microeconomic factors. A lot of people think the Fed can drive the stock market up and down. Well, this shows you the Federal Reserve's Fed funds rate. Again, no correlation. Sometimes when the funds rate is falling, the market's rising. Sometimes the market's rising and the funds rate's rising. No causality there. What's the easy way of doing this? The easy way is you give your money to somebody else and let them manage it for you. Granted, there are good fund managers and there are poor fund managers. So there are funds out there, mutual funds, hedge funds, that can give you a great return. But if we look at the entire population of stock mutual funds over many years, what we find is that these funds on average are loading up in stocks at market tops, and they're getting out of stocks at market bottoms. The greatest example of this is if you go over to the right side, the year 2000, a major top in the market. Look how low the cash levels were, meaning that mutual funds were heavily invested in stocks, had very little cash, and look what happened. The market fell.
So, do you have any advice for investors or traders who are new to the markets?
Yes, if you're new to the market, the first thing that comes to my mind is to study, to learn technical analysis, preferably Elliott Wave, and I wouldn't do anything until I've done some studying, some reading. It could be books on various aspects of technical analysis in addition to Elliott Wave, but also to be conscious of these myths and start to train yourself to not listen to the news so much in terms of using it as as an input for your trading and investing.
And what about advice for investors or traders who are seasoned? Can they still make these common mistakes?
Yes, absolutely. It's so ingrained in our nature, these mistakes that I've mentioned, that it's hard to break bad habits. And even the most experienced traders will sometimes fall back into this type of erroneous thinking. So they just have to guard against it. It happens all the time. It's very hard to extricate yourself from this type of mechanistic view of the world. Sometimes it could take years to really totally feel independent of this and not be influenced by these other items that I've spoken about.
Wayne, thanks for taking the time to chat today. If you're interested in honing your craft and learning more about trading and investing with Elliott Waves, please visit the link below. Thanks for watching Elliott Wave TV.